ARM trades at approximately $286 per share for a market value of $305 billion. At that price, our reverse DCF implies approximately 44.5% annual unlevered free cash flow growth for the next 10 years. That price-implied path takes estimated unlevered free cash flow from $1 billion today to $55 billion in year 10, 40 times the current level. Over fiscal 2023 to 2026, reported free cash flow grew by 13.7% per year. That is the delivered record beside the price-implied 44.5% annual growth path. Is this a future cash flow bet, or is there too little current evidence? To answer that, we run the valuation through three lenses. A reverse DCF reveals what the current price already assumes. A traditional DCF estimates what the business could be worth under bear, base, and bull scenarios. And a price-to-earnings multiple adds context from comparable historical and market anchors when those are available. Three lenses. One conditional verdict. We model ARM's cash engine as units to ask to margin to free cash flow. The template's proposed defense is the platform around the silicon, software, tooling, and an ecosystem that makes switching expensive even when a rival chip looks comparable on paper. For an upside case to hold, three things must be supported: sustained demand cycle, pricing and mix, and supply and capacity. We will test each one later. ARM's stock has materially outpaced the market. That helps explain investor enthusiasm, but not whether the current price is justified. Over the last 3 years, revenue grew approximately 22.5% a year, earnings per share grew approximately 18.3% a year, and reported free cash flow grew approximately 13.7% a year. Reported free cash flow margin moved from 24.1% in fiscal 2023 to approximately 28.5% for the latest trailing period. In the quarter ending June 2026, revenue grew 22.4% year over year, broadly in line with its recent trend. The question is whether that continues. You can see it on the chart. The stock materially outpaced the broader market over this period. That relative performance is useful context for the valuation, not proof of fair value. But recent growth is the starting point of this analysis, not the forecast. The question is never what was delivered. It is what the price now requires. At the time of this analysis, ARM trades at approximately $286 per share for an equity value of roughly $305 billion. Estimated trailing unlevered free cash flow is approximately $1 billion. A traditional DCF starts with forecasts and calculates a value. A reverse DCF does the opposite. It takes today's value and solves for the growth rate that makes the price possible. We use a discount rate of 11.2%. The company's estimated cost of capital, terminal growth of 2.5%, and the company's estimated unlevered free cash flow base. One adjustment first. ARM holds net cash of about $3 billion, so we solve against enterprise value rather than the headline market cap. The result? On these assumptions, today's price implies approximately 44.5% annual unlevered free cash flow growth over the next 10 years. The market's math under our assumptions, not a fact. And the required growth remains demanding. Across reasonable discount rate and terminal growth assumptions, the hurdle stays high. That growth path takes unlevered free cash flow from $1 billion today to approximately $55 billion in year 10, 40 times the current level. Watch it compound. Year 1 already needs roughly $2 billion. By year 5, approximately $9 billion, each year building on the last with no year off. That target has operational consequences. Holding the current estimated unlevered free cash flow margin at 24.7%, ARM would need approximately $222 billion in annual revenue by year 10. The market is not pricing in one more strong year. It is pricing in 10 years of sustained delivery. But does our own forecast produce the same value? Now I forecast the business itself. $5 billion of trailing revenue, and how much of it turns into unlevered free cash flow. The base path starts at 29% and fades toward 5%. That is trailing revenue growth blended with forward analyst consensus. Cash conversion drifts down slightly from 26.8% of revenue today to 24.7%. With a 11.2% discount rate and 2.5% terminal growth, that produces $46 per share. That discount rate is a market value weighted average cost of capital built from a 4.6% risk-free rate, beta of 1.5, 4.5% equity risk premium, and 6.1% pre-tax debt cost. About 53.9% of modeled enterprise value comes from the terminal value, so the result remains sensitive to long-run assumptions. The bear case starts at 24.4% growth and assumes cash conversion never improves at all, holding at 21.7%. It is worth $33. The bull case starts at 33.7% and reaches 29.3%, the best margin it has ever posted. It reaches $61. The width of that range is not our opinion. It is the spread between the highest and lowest analyst revenue estimate, and here they are unusually close together. At $286, the stock sits above even our bull case. The DCF gives us a value. The multiple tells us what investors are paying for it right now. Our final lens is the valuation multiple. ARM trades at approximately 289 times trailing earnings. Based on expected forward earnings, that falls to approximately 93 times. The gap reflects the growth analysts already expect. The company's own median across 3 fiscal observations is approximately 176 times. The broader market trades at approximately 24 times on a configured trailing price-to-earnings benchmark. But the lenses disagree here, and that matters more than either one alone. On forward earnings, the multiple looks reasonable. Measured against the free cash flow ARM produces today, our model says the price still demands extraordinary long-term growth. A fair multiple on forecast earnings is not the same as a fair price for the cash. The valuation survives mathematically, but only if a few conditions keep holding. Now the evidence. Sustained demand cycle is supported. Revenue grew 22.4%. Pricing and mix is mixed. Revenue growth of 22.4% and reported free cash flow margin of 28.5% do not isolate pricing. Supply and capacity is mixed. CapEx at 11.7% of revenue, rising. 1 of 3 is supported. Pricing and mix, supply and capacity remain unresolved. The verdict remains conditional. Now stress the model. The business risks are cyclical demand, competition compresses price, CapEx digestion. The screen translates them into exact valuation inputs. First, cut starting revenue growth to 70% of the base assumption. Fair value falls to $34. Second, reduce the steady-state free cash flow margin by 20%. Fair value becomes $39. Third, raise the discount rate from 11.2% to 12.2%. Fair value becomes $41. Finally, combine all 3 while fading mature growth to the terminal rate. The model falls to $25. These are standardized model stresses, not predictions. They show which assumptions the valuation is most exposed to. These risks do not need to destroy the business. They only need to produce results below what the current price already requires. The standardized stresses show how the valuation moves. But before the verdict, there is one counter-argument this analysis owes you. One more test before the verdict, and it is the simplest here. At the growth rate we forecast 16.8% a year, today's price says the company would have to turn 214.1% of revenue into free cash flow. It converts 26.8% today. There is no version of that. A company cannot turn more into free cash flow than it collects in revenue, and the growth rate is ordinary. It is the conversion that cannot exist. That is the last piece of evidence. So what do all 3 lenses say together? 3 lenses. Here is the verdict. Lens 1, the reverse DCF. The price demands 44.5% growth every year for 10 years, an implied free cash flow path well above what the company recently delivered. Lens 2, our own DCF, $33 in the bear case, $46 in the base case, $61 in the bull case, and the current price sits above even our bull case. Lens 3, the multiple, a premium on trailing earnings, but roughly in line with its own median across 3 fiscal observations, once you account for the growth analysts already expect. The combined downside case lands at $25, approximately 91.3% below the current price. Add the 3 together and the tell is clear. On earnings, the stock is not expensive. The multiple is no warning here. The pressure is all in the cash flow. Even our most optimistic scenario cannot reach today's price, with our base case roughly 84% below it. This is not a rich multiple story. It is a price paying for years of free cash flow growth beyond what even our bull case assumes. So what would have to be true for today's $286 to be right? Growth far above our bull case, closer to the 44.5% a year the reverse DCF backed out. That distance is the expectation gap. Our overall verdict, priced beyond our bull case. Business quality and investment value are different questions. This conclusion remains conditional on the evidence and assumptions shown. That is the analysis. Thank you for watching. This analysis is a valuation framework, not financial advice. The result depends on the assumptions shown, and you should always verify them and do your own research. Snapshot, August 6, 2026. Position, not disclosed. The description lists sources, method, and AI use.